Medexus is a pharma company trading on the TSX under the ticker symbol MDP. Lots of information at our website, medexus.com, including our forward-looking statements. So in a nutshell, really, Medexus is a pharma company that's serving unmet medical needs in the marketplace, both US and Canada. So a lot of the heavy lifting actually has been done. So, we've got a business now that last year we reported $108 million of revenue. Those are all US dollars. We report in US dollars. I think most analysts have us coming in at $120 million of revenue this year. So we've been on a really nice, strong growth trajectory for several years, about 25% compound annual growth. The risk is spread over about 17 products in the marketplace, both the US and Canada. About 3/4 of our revenue comes out of the US at this stage. So that piece of our business will continue to grow very strongly. Eventually, I think when we have our portfolio fully built out, it'll be more like 90-10. As I mentioned, most of the heavy lifting's already been done. We have commercial infrastructure built out throughout both US and Canada. So the magic in the business now is really leveraging additional products on top of the existing base that exists, which is a very durable base. So the 108 or 120 million of revenue, that's very durable revenue that we expect to continue on into the future. So we add our pipeline products on top of that, plus any additional licensing or M&A that we will do. The ultimate goal is to build scale in this business and be something more like 500 million of annual revenues, producing 20 or 25% positive EBITDA. So we're part of the way through our journey. This is a company that I founded. I still own a significant portion of the equity. So the business model is dead simple. It's been done before. Companies like Jazz and Horizon have had exactly the same strategy and been very successful doing it. So the business model is very much grow organically. We have a portfolio of products that we've been growing that's produced that 25% growth. We acquire our products through business development. So it's licensing and M&A. There's no binary event where we're looking to develop a drug. We don't spend on research and development. We are licensing and acquiring these drugs from organizations that either don't have a commercial footprint in North America or are drug developers and are looking for a commercial partner. So we're very much on the commercial side of the business, and so there's really no binary event within our business model. We do a little bit of product development, so sometimes we acquire drugs that need some additional work in order to improve the label. We will do that work, and a good example of that is IXINITY, where we're adding a pediatric indication. It's one of our top drugs. So when you look at our financials and see an R&D, it's really for product development. So this is the core of our portfolio. We're really focused in highly specialized therapeutic areas such as hematology or hem-onc, rheumatology, rare disease being glioblastoma, so cancerous brain tumors. And then we have a bit of an outlier in Canada where we actually have an allergy business, which is not necessarily strategic, but it's highly profitable. So we've kept that piece of business in Canada only. We will not replicate that in the US because we don't want to expand that broadly, have such a large sales team. So in each of those areas, we have several products, either already on market or are coming through our product development cycle and waiting for registration. So a lot of our growth will come from future product launches, and I'll touch on those in a future slide. As I mentioned, a lot of the work has already been done. We spent the last 5 years since we've been public building the infrastructure, building the sales teams, having a base upon which we can add more products. So as we now go forward and add products that are typically at 60+% gross margins and not adding infrastructure to support them, obviously a lot of that drops to the bottom line. And that's where you see a lot of the value that is built in the business. As I mentioned, we have done this both in the US and Canada. Our focus is very much North America. We have no plans on expanding beyond the commercial footprint that we have today. One of our lead products is a product called IXINITY. This is for hemophilia B. It's a rare disease. There's only 4,000 to 5,000 patients in the US that have this disease, about 700 in Canada. Basically, what our product does is replace the factor that's missing from their blood, and that will allow their blood to properly coagulate, stop bleeds. So this product, we do about $40 million of revenue in this product. We've grown it nicely in the couple of years that we've had it. And this is the product where we're adding a pediatric indication. Hemophilia is diagnosed in childhood. Parent will notice that the child bleeds unusually, and therefore they get diagnosed and then usually treated. So we've been able to build these revenues without having a good label, because we are only currently indicated in adults. So the work that we've now completed and filed with the FDA, we'll get a decision in April, this coming April, and hopefully that will add the pediatric indication to our label, which will allow us to promote those new patient starts. So that's obviously the best place to be. So I think we've actually done a pretty good job in building this portfolio and this drug without having a very good label. So that will change, and obviously that's going to provide an opportunity for us. Rasuvo was another one of our larger products. This is one that's really now kind of matured. This product we launched behind a competitor. We caught that competitor, we passed them, and now we hold better than 80% market share in this particular market. So nice mature drug that has nice durable sales into the future. Gleolan is a product that we have most recently licensed for the US. We've had this in Canada for a couple of years and performed very well. The partner recognized that performance and licensed us the product in the US as well. And now we're in the process of relaunching this drug. It does about $12 to $16 million of revenue, US dollars, when we acquired it. We're doing better than that now, and we see this continuing to grow into the future. Basically what this drug does is cause brain tumors, cancerous brain tumors, to fluoresce pink under blue light. So it completely changes the game for the neurosurgeon, who now can easily see what is cancer and what is just normal brain tissue. So it allows them to be much more aggressive in taking out the cancer, which leads to better survival for the patient. So clearly, this is kind of a life-saving a drug for many of these patients. And so we think we can grow this significantly. The partner that we have is doing a clinical program which will add a new indication for this drug, which will more than double the opportunity for the product. So you can see organic growth to us is really, really important. The one outlier that I mentioned, this is Rupall. This is Canada only. In Canada, we have basically a primary care sales force calling on general practitioners, and this is the lead drug in their portfolio. This is a product for seasonal allergies. That's why you see kind of the strange growth curve, where it climbs in the spring, peaks in the summer, starts to decline in the fall through winter, and then repeats the cycle. But even with that seasonality, you can see we've had 37% compound annual growth with this product. So a really, really good performer. And this is a therapeutic area that we want to continue to support in Canada only. I think an important part of our story is the fact that we've deployed capital really well. There's two examples here where we've paid less than one-time revenue to acquire these drugs. Rasuvo, we paid $13.9 million for a drug that was doing about $25 million in revenue. We put a lot of the economics for the partner in an EBITDA trailer. So their success is tied to our success and us growing the business. So I like those deals a lot better because it doesn't put all of the risk on Medexus. IXINITY was another good example of deploying capital well. We paid $30 million for that drug. It was doing about $30 million in revenue. Now it's doing about $40 million in revenue. And it's a very durable revenue stream. So, again, I think we properly structured those deals, deployed the capital in such a way that we're not taking on all the risk. So as we go forward, obviously we're trying to be very, very efficient in how we deploy our capital. So the way you should think about Medexus is that we've got a really solid base of business. So it's durable revenues in $100+ million. And then we've got a nice pipeline. The pipeline will help provide growth into the future. There's 5 products in our pipeline, so it's not all associated just with one product, but treosulfan is a significant part of those 5. Treosulfan is a product that we've launched in Canada. It's performing very well in Canada, and we're waiting for the resubmission of that product to the FDA in the US. In the US, we think it's about a $100 million drug. It's basically used in stem cell transplantation, which is an effective way to treat certain types of leukemia. If the transplant works, it is curative. So you can cure certain types of leukemia by doing these procedures, and treosulfan, is a basis of these procedures. In Europe, it's become the standard of care. We do expect it would become the standard of care in North America as well. In Canada, we're well on the track to that. In the US, assuming it gets approved, it'll be refiled in April, and a decision would be about a year from now, so next October. And if that were to be approved, we would quickly launch shortly thereafter. So strong potential for growth. It could almost double our current revenues. IXINITY, as I mentioned, we've got a pediatric study that has been filed. We expect a decision from the FDA in April, and that'll be an important addition to the label. Can you imagine that, we've built this business to be about $40 million, just getting switches in adults. And that's not great because most patients who start in childhood, those products that they're put on work pretty well. And so often there's not a need to switch. And so that's where we want to get our patients to start, is in childhood. And then you get them throughout their life, because you're not curing this disease, you're just replacing what's missing. So they will use this throughout the child's life, right through into adulthood. And it allows them to basically live a very normal life. So this pediatric indication is going to give us a label that's equal to our competitors, which we think will be significant. Gleolan, there's a study going on in meningioma, which is a non-cancerous brain tumor. It works just as well in non-cancerous tumors. And so that would more than double the potential for the drug, because non-cancerous brain tumors are a lot more prevalent than cancerous ones, fortunately. Then we've got triamcinolone hexacetonide, which has been launched in Canada. We expect to do the same in the US. It's for juvenile idiopathic arthritis, basically a type of rheumatoid arthritis that affects children. And then finally, terbinafine in Canada. Rupall is going to experience some loss of data exclusivity in 2025. And so we've licensed this product to replace those revenues. So we would expect a slow erosion of Rupall, and those revenues will be replaced, and then some, by terbinafine lacquer. Basically, this is a product, you've all heard the commercials, gee, your nail's really gross, you should do something about that, go see a doctor. That product in Canada is about $80 million, and there's just one player. Our product has got a convenience improvement on that product, where they have to be used every day for a year. Our product, it's once a week for a year, equal efficacy. So clearly we think we'll get a really, really strong second position with that product. So if you've been following the story, you'll know that we've shown this really nice, consistent revenue growth. Quarterly, again, really strong revenue growth, record quarter after quarter, to the point where we produced about $6.6 million of positive EBITDA last quarter. That was an exceptional quarter. That was a really good quarter. So I wouldn't stand up here and say we're going to do that every quarter, but the new normal is probably in the $30 million range, $5 million of positive EBITDA, which is consistent with the analysts are saying about our products. So we're really pleased with the position that we're currently in, except for our share price, obviously. I don't think you've ever heard a CEO that said they didn't think their share price was undervalued. I definitely think ours is undervalued. I look at our competitors, they're getting 8, 9, sometimes 10 times multiple on EBITDA. we're getting like 3. So clearly we think, we do have some opportunity to increase our share price with existing portfolio plus the pipeline that's coming along, which is really kind of in the near term. It's within the next 12 months. This is our capital structure. There's been a lot of talk about our capital structure in the last probably 6 or 12 months. We've had this convertible debenture on our books. We've been saying for a very long time that we intend to pay this off totally in cash. A lot of people didn't believe us, but I'm very pleased to say we are going to pay this totally in cash. That'll happen on Monday, which is the maturity of this debenture. So when you're doing your math, you should think about 23 million shares outstanding. That's the proper share count. And then do your math on what you think the base business and the pipeline is worth. We do have a nice credit facility in place. This is what has allowed us to take care of that debenture in cash. We replaced some mid-cap debt at a lower interest rate with BMO. BMO exercised an accordion on Labor Day. That accordion will be applied to the debenture plus the cash that we had on hand, which is going to take care of the debenture. So really pleased to have a good partner who is with us for the long term. The interest rate is basically SOFR plus about 2.5. So really pleased with the interest rate. And that's the ceiling. As we get bigger, that 2.5 will actually come down. So when you look at our company, I think you should really think about, a platform of business in both the US and Canada, completely built out. A group of products that are producing very durable sales. On top of that, you've got this pipeline of products that we expect to come in the pretty near term, and then we will continue to work in growing the business. My vision is that I think that the current portfolio plus pipeline can get us to about $250 million in revenue, US dollars, but we want to be more like 500 million of revenue. That's when we start to get proper scale. That's when our bigger pharma partners, start to look a lot like us. We get more, better multiples on our EBITDA and our revenues, as we get up to that kind of size. There's a lot less risk in the business as we build the portfolio, spread it over more products. So that's where we're trying to get to. So we're part of the way along that journey, but still got lots of room to go. So that's our story. Thank you so much for your attention. Appreciate it.